All right, let's talk about something you hear about all the time, a real cornerstone of the global economy, bonds. Now, they might sound super complicated, but they're absolutely fundamental to how governments and companies get things done. In this explainer, we're going to demystify the whole thing. Let's get into it.
So you're watching the news, right? And you hear some experts say bond yields are rising. It sounds really important, and well, it is. By the time we're done here, you're going to know exactly what that means, and more importantly, why it matters to all of us, even if you don't own a single bond.
So what on earth is a bond? Let's just forget all the financial jargon for a minute. At its heart, a bond is actually super simple. Think of it as a fancy IOU. When a big company or a government needs to borrow a ton of money, they issue bonds. And when you buy one, you are literally lending them that money. Simple as that.
Okay, so every bond basically has three main parts. First up, you've got the face value, or par value. This is typically $1,000, and it's the amount you get paid back at the very end. Then there's the coupon. That's the regular interest payment you get for loaning them your money. And finally, you have the maturity date. That's the day the loan is officially over, and you get that $1,000 face value back. See? Not so bad.
All right, now if you remember just one thing from this entire explainer, make it this. The price of a bond and current interest rates have this inverse relationship. It's like a seesaw. When one side goes up, the other side has to go down. This one concept is the key to understanding pretty much everything about bonds.
So let's start with a perfectly balanced seesaw. Imagine you buy a brand new bond for its face value, $1,000, and it pays an 8% coupon. Right now, the overall market interest rate is also 8%, so everything's in perfect equilibrium. Your bond is worth exactly what you paid for it, $1,000. Easy. But of course, the world doesn't stand still, right? Markets are always changing. Let's say a year goes by, and now, to attract investors, brand new bonds are being issued with a much juicier 10% interest rate. Uh-oh, this creates a little bit of a problem for you and your old boring 8% bond.
And that leads to the big question, doesn't it? If you wanted to sell your bond, why on earth would anyone pay you the full $1,000 for it? They could take that same money and just go buy a shiny new bond that pays them 10%. It's a no-brainer. Your bond is suddenly way less attractive.
So what has to happen? Well, the price of your bond has to drop. It has to sell at what's called a discount to even have a chance of competing. The price falls to about $885. So let's recap. Interest rates in the market went up, and the price of your existing bond went down. That's our seesaw.
Okay, now let's flip that seesaw to the other side. Imagine the opposite happens. The economy cools down, and new bonds are only being issued with a pretty measly 6% interest rate. Well, what does that do? All of a sudden, your old bond that's still chugging along, paying out a reliable 8%, looks absolutely fantastic.
Now your bond is a hot-ticket item. Everyone wants it. So buyers will actually bid the price up to get their hands on that higher 8% payout. The price rises to what we call a premium, in this case, to over $1,100. So this time, interest rates went down and your bond's price went up. The seesaw in action. So price and yield, that's the main event, but it's not the whole story. The value and the risk of a bond also comes down to the legal contract behind it. It's called the bond indenture. So yeah, it's time to decode some of that dreaded fine print. So here are three key things you'll find in there. First, seniority. This is basically your spot in the line if the company goes bankrupt. Do you get paid first or last? Then you have a call provision. This is a big one. It lets the company buy the bond back from you early, which you can bet they'll do if interest rates fall. And finally, protective covenants. These are rules the company has to follow to protect you, the lender. And believe me, once you step outside of the plain vanilla government and corporate bonds, the real world gets very, very creative. Things can definitely get a little weird. I mean, check these out. Bowie bonds were a real thing. David Bowie literally bundled up all the future income from his incredible music catalog and sold bonds backed by it. How cool is that? And then you have things like a death put. It sounds grim, but it's a provision that lets your family sell the bond back at face value if you die, which is actually a great deal if rates have gone up and the bond's price has fallen.
So we've got a handle on how one bond works. But now let's pull the camera back. Why do the yields on millions of bonds all moving together matter so much for the entire economy? Let's take a look at the big picture.
You see, a bond's yield isn't just one number. It's kind of like a recipe with at least 6 different ingredients. You start with a base rate of interest, then investors start demanding extra little payments or premiums for taking on all sorts of different risks. There's a risk of inflation, a risk the company could go bankrupt, even a risk that you can't sell the bond easily. All of these get baked into that final yield you see.
And out of all those ingredients on the list, which one is the big one? The one that really drives the whole thing? You guessed it, it's inflation. It is the silent, powerful force shaping the entire bond market. So when you see an interest rate on the news or in a bank ad, that is the nominal rate. It's the sticker price. It's the straightforward number. It tells you how many more dollars you're going to have, but it doesn't tell you a thing about what those dollars can actually buy.
The real rate? Now that's the number that really matters. It's your actual return after you factor in inflation. So if your investment gives you a 15.5% return, but prices for everything went up 5%, your real gain in purchasing power is only about 10%. That's the number that tells you if you're actually getting any wealthier.
And this whole relationship has a name, the Fisher effect. And you know what? The math is actually pretty simple. The nominal rate that you see everywhere is basically the real rate of return that investors want, plus whatever they think inflation is going to be in the future. So, when you hear that bond yields are rising, it's often a huge signal that investors are starting to worry about higher inflation coming down the road.
So let's wrap it all up with this thought. The next time you see a chart of bond yields on the news, the Treasury yield curve, you'll know what you're looking at. It's not just some random number. It's the market's collective wisdom all in one place. It shows you its fears about risk, its bets on inflation, and its best guess for our economic future. So, what story is it telling you?